What is going on, investors? Hopefully you guys are doing well out there. First here on the channel, we're going to look at Super Microcomputer, ticker symbol SMCI, one of the darlings of the AI boom, because over the last year, shares of Super Micro up 717%. Look at this. Year to date, shares are up 202%. Will Super Micro be able to continue this? Because we've looked at busted growth companies here on the channel before. We've looked at Enphase Energy. We looked at Zoom Video. We looked at Lucid. Will this company become a busted growth stock? If you don't know what that is and you're investing in Super Micro, you definitely want to tune into this video. If you know what it is, let me know down in the comments down below. Do you think Super Micro will be able to continue this type of momentum and push from a $53 billion valuation even higher? Or is this one going to flame out like the rest? We'll talk about that and more on today's show. Revenue in the most recent quarter, the Q3 fiscal quarter for Super Micro, coming in at $3.85 billion. That was just 200% growth year over year, but it did miss expectations that are elevated by over 50 million. Wall Street was expecting $3.9 billion. We came just underneath that for Super Micro. But never fear, the fiscal fourth quarter is coming, and we're expecting net sales for Super Micro to be $5.1 billion to $5.5 billion. Wall Street expectations was for 122% growth. That would have been $4.9 billion. So this company coming a little light in the most recent quarter, but it looks like maybe some sales got pushed out to the next quarter. When we looked at TSM, when we looked at some of the semiconductor stocks, a lot of them said the back half of the year looks a little bit better and a little bit more clear than today. So this lines up with all of this, and the fact that they've come in a little light in this quarter, but it's going to follow through next quarter. Perfectly acceptable for this company. Now, let's come over here and look at these financials, because when we look at these growth stocks, like an Enphase, like a Zoom Video, like a Lucid, the one thing that I really want to see is some really high gross profit. And that's when you take your net sales and you minus off your cost of sales. Now, Super Micro doesn't have high gross margins. You have $3.9 billion. Look at this, $3.3 billion worth of cost. Where are they going to get that operating leverage when it comes to gross profit? I say $597 million on gross profit, because we have to remember, we're not talking about a $5 billion company. We're talking about a $52 billion company that has to maintain the type of growth rate that it's at. Otherwise, that valuation is absolutely insane. Research and development over the last year went from $77 to $116 million. You're going to take your gross profit and you're going to minus off R&D. Then you're also going to minus off sales and marketing. So despite the record sales, again, up over 200%, there's nothing negative to say about 200% growth. It's all positive. But it does come at a cost. Look at your sales and marketing spend over the last year, from 25 million all the way up to 50 million. So you basically doubled your sales and marketing spend to drive this 200% growth. Now, you've also got general administrative. That went from 24 up to 53. So yes, your sales are ramping up at Super Micro, which is illustrated by the stock chart as well, completely ramping up. But obviously your operating expenses as well. Nobody would expect anything different, right? But the question going forward is, can you start to flatten them out? Can you expand operating profits? Can you expand gross margins at Super Micro? If you can, the stock can keep things going. If it can't, then you turn into Enphase Energy, Zoom Video, and even worse, you turn into Lucid. Now, operating expenses over the last year went from 127 up to 219. So you take this 597 in gross profit minus off 219 in operating expenses, you get your income from operations, ba-boom, up from 99 million all the way up to $378 million. Pull down to a net income number of over $400 million. That's a big time increase over last year, where you were at $85 million. For the last 9 months, this $400 million is sensational, because for 9 months, you printed nearly $855.5 million in net income. Basically, half of that showed up in this quarter. So the sales are starting to come in for Super Micro. Now, the next thing I'm going to point to is the fact that on their financials, they don't give you a full cash flow readout. And so that's not that big of a deal, but they do give you the high level. Your net cash provided by your operating activities was a negative $1.9 billion. The bear case is going to grab that number by the neck and go run and say you should short this stock, because last year you had positive operating cash flow at 672. And again, despite higher revenue, much higher net income. You bled through nearly $1.9 billion in 9 months operating the business. Now, we had to pull up the 10Q from the previous quarter because I had to see what was contributing to this company having such strong revenue growth, such strong profit growth, but having negative operating cash flows. This was a little concerning, but we have to understand this company's business model. They have to acquire lots and lots of inventory. So this company has to pay, it looks like, for their inventory as they bring it in. They assemble these servers and the products for the customers. So look at this. This is for the 6 months ended. I am showing you for a 9-month ended. Company spent $1 billion on inventory. My guess is this quarter, they're having to stack inventory again. So a little bit of a punishment, if you will, for having this high of a growth rate is they have to come and pay for a lot of inventory in cash. And so despite increasing your revenues very rapidly, increasing your profits very rapidly, you have to outlay quite a bit of cash in order to have next quarter and the following quarter's inventory. And so it really hurts your cash flow. So what are they doing? They're raising money over at Supermicro. Back in February, they raised a $1.5 billion convertible note, which when you come over here to the balance sheet, you see that it was basically oversubscribed to the tune of nearly $1.7 billion. Now, that convertible note's interesting because it came when shares of Supermicro were almost at all-time highs, and you have initial conversion price of nearly $1,341 per share. And with shares of Supermicro currently at $8.58, there's people that bought into that convertible note that might be a little upset at the current time. So this company raised on this convertible note, not due until 2029. So you've got some time to figure some things out. It certainly gave you the cash you need to invest in this inventory that's going to fund your future growth. Now, we have to talk about growth as well. Most recent quarter, 200%. Look, that's fantastic. Next quarter, going to be a little higher than Wall Street expectations. They were at 122. My guess, company will hit this 5.1 to 5.5 billion dollars. So you're over 125, 30, nearly maybe on 140% growth. But then you start lapping quarters. And this is what we saw with Enphase. This is what we saw with Zoom Video. This is what we saw with Lucid. At some point, you start lapping this stuff. And 200% growth goes down to 50% growth, which is still fantastic. Then it goes down to 30% growth. And when you don't have these massive gross margins and you're constantly having to sink more and more money into inventory, it had me worried a little bit as a growth investor. Now, from a technical perspective, I mean, this thing has absolutely gone absolutely bonkers. It was on a beautiful uptrend, really, since 2018. You were making higher highs, higher lows, almost consistently. And then I think understandably, and in a lot of ways for good reason, has gone completely out of control. But this type of uptrend is simply not sustainable. Ask the companies that we keep referencing in terms of their busted growth. This company's growth is going to slow down as you head into the back half of this year. As you head into next year, they're going to have to continue to fund their growth with more and more cash. They don't have high enough gross margins to really get you excited. When the growth drains out of this company, the high gross margins can keep you interested. Zoom Video has incredibly high gross margins. So does Enphase, and both stocks have been absolutely bludgeoned over the past couple of years. SMCI has a destiny to come back all the way down to $300 per share. I think more likely we're going to come all the way back down to trend. I think within a year or two, you're going to be looking at about $150 per share. They're going to have to continue to fund things with convertible notes, different types of debt. This space is competitive as it is, and the margins just don't have any ability to expand. Unlike an NVIDIA, unlike the actual chip makers that they're buying to put into their servers, they don't have any ability to do that, and I would avoid Supermicro going forward. There's going to be some people upset in the comments, but that's the opinion here on the Investor Channel. Hopefully you guys enjoyed today's video. Join us again on Friday. Love us or hate us. We'll see you then.